Good afternoon, everyone. Those joining from the US, of course, a good morning to you. I'm going to be chairing the session, which basically means I'm just going to be keeping time. That's about it. Raman has already announced the time, so you're well aware of the allotted time. There's 25 minutes for the presentation, 20 minutes for the discussion. So discussant is going to get 20 minutes, and then we'll have a Q&A session for 10 minutes. So without wasting any time, I'm going to give it to Guillaume, who's going to present his paper titled Evading Corporate Responsibilities, Evidence from the Shipping Industry. Guillaume, you have 25 minutes.
Thank you very much, Vikrant, and thanks to all of you for being here. So let me start very simply with the motivation. So there is clearly a growing concern about doing business responsibly. Very often there is some blurriness around what we mean by corporate responsibility. So here, let me be very straight up front about what I will mean. So I will mean the ability to avoid disasters in day-to-day operations. I will mean compliance with regulatory standards, and I will mean the ability to potentially trade off short-term profit for long-term impact. And the key question I'm after is whether some key features of corporate law or of corporate structure can affect business responsibility based on those three dimensions. And in particular, I'm going to focus on probably the most important feature of corporate law, which is limited liability. Limited liability, as we all know, allow investors to limit responsibility in some sense, meaning if they cause some damage and this damage is fined to them, then if the fine is too large, they may not be able to pay, and there is some limit to the extent they may be required to pay. And even so, today we tend to take limited liability as a necessary feature of equity. It is not, and there was a clear historical process through which limited liability for equity holders developed, and for a very long time, actually, shareholders had extended or unlimited forms of limited liability. And so, in a sense, I intend also this paper to talk a little bit about the costs and benefits of liability and maybe the optimal extent of liability. When we think about this in economic theory, very often we think along the following lines. On the cost side, the main cost we typically have in mind is the very standard risk-shifting problem of Jensen and Mackey. Okay? And on the benefit side, we have a variety of them, but typically the way we think about that is really benefits for individual investors. For example, one standard argument is that it allows investors to hold much more diversified portfolios of stocks. Okay? That said, some costs, in my view, remain a little bit in the shadow. First of all, when we think about risk shifting in corporate finance, typically we think about risk shifting vis-à-vis debt, vis-à-vis contractual creditors, so either banks or bondholders. But of course, in practice, risk shifting can also be vis-à-vis tort creditors, for example, victims of environmental damages. And the key difference is that those tort creditors are not part of any contract with the firm, and so they cannot protect themselves, for example, with covenants or by negotiating other aspects of the contract. Okay? And second, on the benefit side, even so, most of the arguments we have in favor of limited liability are for individual investors. Limited liability also benefits groups in their relation with subsidiaries. And when you put all this together, it gives the potential for companies to structure themselves in parent subsidiary corporations and moving all of the businesses that are socially costly to subsidiary. Okay, and so that gives rise to a potentially large-scale corporate irresponsibility. And so what I'm going to do in this paper is to study this type of incentives in one given industry, which will be the maritime shipping industry. Why this industry? Well, first, it's economically extremely relevant. It represents about 80 to 90% of global trade flows. And so it's really the backbone of globalization. Okay? And as I will argue, all of the dimensions of environmental responsibility are relevant in this context. You have the potential for disasters in the form of oil spills. You have lots of regulatory issues. And there are also issues about the long term, in particular with the recycling of these extremely large ships. Okay. What I will document first is 3 trends which are extremely strong in the data, which are all consistent with the fact that the industry itself restructured so as to escape those corporate responsibilities as I defined them. I will not go into details at this stage for the sake of time, but I will, of course, explain this in some details later on. And then I will look more at the microeconomic patterns and have a variety of tests to really show that liability evasion or responsibility evasion is really driving the trends I will be documenting. Before I get there, I need to give you a little bit of background very quickly about this industry. So first thing is that in international law, the high seas are free from state sovereignty. So no state can claim sovereignty on the high seas, but all ships are required to fly a flag. Okay? And this flag is extremely important because it determines, so to speak, the nationality of the ship and so the national law to which it must comply. Okay? And so traditionally, there was a very well-established principle in international law, which was the so-called genuine link principle. So for example, if you had a ship owned by a Greek corporation with Greek seafarers, naturally this ship would fly the Greek flag. What has developed, and I will document this quite a bit, over the past few decades is what we call flags of convenience. And flags of convenience are precisely about doing away with those genuine links. So you can have some countries, typically some small islands or some countries not exposed to maritime risks, that can run what we call open registries. So upon paying a fee, you can just be allowed to fly the flag of this country. And so this country typically offers much lower taxes or no taxes at all, lower safety regulation, lower environmental regulation, and so on. And so to give you a very concrete example, you can take the exact same ship as before, owned by a Greek corporation. If it flies the Liberian flag, it does not need to go a single time in its life to Liberia. But yet, if, for example, it causes an oil spill, it will be considered Liberian in international law. Okay? And of course, it will be subject to the regulation of Liberia. Okay? And Liberia is one of the biggest flag of convenience worldwide. Okay? And so to manage this, traditional countries have essentially one main way, which is what we call port state control. So they can just check the quality or the compliance of ships that enter their domestic waters or their domestic ports. Okay, and eventually substandard ships can be detained. Okay. Very last thing before I move to the tests, I need to introduce 2 terms. When you think about the ownership of a ship, so think of a tanker or a container ship, we typically distinguish between the registered owner, which is the legal owner of the ship, and there is the beneficial owner, which is the corporation or the individual that ultimately benefits from the ownership. Okay, so of course the two can be the same, but if you think of a parent subsidiary structure, typically the subsidiary will be the registered owner and the parent company will be the beneficial owner. Okay, and there is a third type of agent which I will not discuss today, which is the operator. And of course, all of these can be the same or they can all be different. Okay. In terms of data, I have data from a database called CWeb from Market, where I can observe the entire global merchant fleet, and I can track every single ship throughout its life, even if it changes flag, ownership, and so on. And so I know many characteristics of these ships. And for reasons of data collection, I limit myself to the biggest ones, so all ships with gross tonnage above 50,000 tons that ended their life between 2000 and 2019. Okay, and so I observe those ships every month from their birth to their death, and so that gives me about close to 500,000 ship months observation. So the first thing I want to focus on is thinking about the ownership. If you want to structure your company to evade potential liabilities, you should dissociate the ownership of the ships to exploit limited liability in several ways. So first of all, you should dissociate the beneficial ownership from the registered ownership, meaning you should put all of your ships in subsidiaries. Okay. Second, what you should do is not just this, it's also to do what we call asset fragmentation, meaning put not all of your ships in the same subsidiary, but create a different subsidiary for every single asset, so for every single ship. Okay. And there is a third dimension, which I will not discuss because I didn't define the operator very carefully, but you can also dissociate the ownership from the operation. Okay. And so the first thing is just as a descriptive number, for each ship in my sample, I first compute the percentage of months spent with a registered owner that differs from the beneficial owner. Okay. And I count the percentage of months. So if you look at the first line here, we see that at the median, the two are the same in 0% of the months. Okay. If you go at the 75th percentile, a ship spends only 6% of its lifetime with the same group owner as registered owner. So this dissociation is extremely widespread. What is more interesting is if you look at the time trend. And so here I'm simply regressing a dummy equal to 1 if there is ownership dissociation on some decade dummies. Okay, and as we see, the fact that the two owners are the same is becoming less and less frequent over time, meaning there is more ownership dissociation. Okay, and interestingly, what the regression allows me to do is to put, of course, some fixed effects at the ship level and at the beneficial owner level. And so to really look within ship and within corporate group, so to mitigate concerns related, for example, to selection. And so we see that indeed within the same ship, within the same group, this dissociation has becoming more common over time, consistent with the idea that it is really not a sample selection issue, but really an active decision of corporate groups to move ships increasingly to dedicated subsidiaries. Okay. What you may ask is, okay, now I showed you that there is this dissociation, but are there really one ship subsidiaries? In order to know this, I need to know all of the ships that are owned by every single subsidiary. And so I cannot do that with my baseline sample because I limit only on the bigger ships. And so just for one single date, which was September 2020, I downloaded the entire data set. So I know all of the ships in the world at that point in time. And so I can look and I observe that 90% of corporations that are registered owners of ships are indeed one ship structure. Okay. And even if I limit to groups holding a relatively large number of ships, for example, above 10 ships, I still find this dissociation to be extremely prevalent. So now you may wonder, okay, perhaps this broad trend, so this fact that this dissociation has been increasing over time is consistent with responsibility evasion. Okay, but we want to test that. Okay, and so of course the problem here is that it's really a global trend, and so it's hard to find, for example, a clear control group. So what I will use as a strategy is a variety of things. Is first some theoretically motivated cross-sectional and time series trend tests, and also some exogenous variation, or at least plausibly exogenous variation, at the ship level. Okay. The first thing is that if it is really the case that this dissociation occurs in a way to evade potential responsibilities, then in the cross-section, you should see that companies that have more ships should do it more. Okay, just because in case, for example, there is an oil spill, there is more assets that could be seized, and so the incentive to shield those assets in different subsidiaries should be bigger. Okay, so this is what I'm doing here, and this is exactly what I find. Okay, and this holds even with ship times beneficial owner fixed effects, meaning when a given company becomes bigger, it also becomes more likely to shift other ships in the same company to subsidiaries. Okay, that's quite a strong result. Second, in terms of ship characteristics, if ships are more likely to generate bigger liabilities, they should probably, again, be more likely to be pushed to different subsidiaries. And this is what I'm seeing here. Bigger ships, older ships, and single hull ships, so this is mostly relevant for tankers, are all more likely to see this dissociation of ownership, again, within a given corporate group at a given point in time. Okay? So that's all consistent with liability evasion. The last test, which is probably better in terms of identification, but a bit weaker in terms of power of the test, is to use detentions under port state control. The basic idea here is, as I told you, when you are, for example, France or the UK or the US, the way you can react against flags of convenience is by checking randomly ships that enter in your domestic waters. And if you find that the ships are in really bad conditions, you can detain them. Okay? And the exact timing of these detentions is arguably quite random because detentions are themselves quite random. So at least at high frequencies. Okay? So for example, the fact that you get checked now or in 3 months or in 5 months is presumably quite random. And so what I will look is looking at ownership changes around these detentions that arguably bring very bad news about the state of the condition of a ship. What I find is that all characteristics of ships are likely to change. So there is some change in the 3 months following those detentions. So they are likely to change group, to change registered owner, and also operator. But if you look at the magnitude, you see that the effect is bigger for changes in registered owner as opposed to changes in beneficial ownership, consistent with the view that at least in some cases, the ships remains within the same corporate group, but is moved to a different subsidiary, just following this bad news about its condition. So that's all for the first part of the paper, which is about ownership. Now let me move to the second part, which is about regulatory evasion. Okay, and so here it's really the issue of flags of convenience. I will be using 2 definitions of flags of convenience. The 2 are relatively standards. And if you look first again at long-term trends, so this is just using data from the UN, you see that the share of the world fleet weighted by tonnage registered in flag of convenience has been booming over the past 4 decades. Okay, if you break it down into different types of ships, the trend is there for all types of ships, but is particularly strong for container ships. So really this backbone of globalization, where it went from below 20% to above 80% in 2019. Okay, so it's really a complete paradigm shift in terms of where those ships, those container ships, are registered that occurred over the past few decades. Okay. If we do it in terms of regressions, it's not very surprising that it works. So you see this trend in the dummy variables. What the regressions also allow me to do is to add fixed effects and to show again that these time trends are robust to beneficial owner and ship fixed effects, consistent with the view that it is not just a selection effect that is driving this aggregate trend, but it is really an active decision of companies to reflag the ships. Okay. So now, in terms of the drivers of this trend, you may ask, okay, but if I already have my ship in a subsidiary, in a dedicated subsidiary, what else does the flag of convenience buy me? Okay, and so it buys you a few things. It buys you first increasing concealment of information, much lighter safety, environmental, and technical requirements, typically no manning requirements. So for example, you can operate with any crew nationality, maybe with lower checks on the training of the crew or with fewer people on board. And taxis may play a role, but in my view is a bit less likely to play a role just because even traditional maritime countries have lowered taxation very much on shipping industry. Okay. And so you can think, well, all of these benefits which reduce costs should be particularly valuable in a context of global competition. And so here the broad hypothesis is that this very wide trend really corresponds to the last globalization wave, and that essentially the shipping industry had to evade to flags of convenience in order to keep up with lower and lower transport costs. Okay, so to test this hypothesis, again, it's a trend that affects more or less everyone worldwide. So I will only have suggestive tests, not a super clean experiment, but I have two types of tests. The first one is simply to think, okay, in the time series, those benefits of reducing costs should be particularly valuable at times freight rates are low. Okay, this is true provided there is some fixed cost of operating a ship. Okay, and so what I'm going to look at is whether within a given ship, so with ship fixed effects, ships are more likely to move to flags of convenience. At times, freight rates are low. Okay, and freight rates are measured here with the Baltic Dry Index, which is probably the most standard measure of freight rates globally. Okay, and across 4 regressions, this is essentially what we find. Okay, you are more likely to shift when freight rates are low and less likely when they are high. The second test is better identified, but here the power of the test is really low. So I just want to show it to you, but I don't want to make too much out of that. Now what I want to look at is when at a group level, a group loses a ship at sea. So presumably this is random. This is due to, for example, weather events. And then that's quite a terrible event for a shipping company. And so it suddenly becomes more financially constrained. And then the question is whether the company becomes more likely to move other ships within the corporate group to flags of convenience, to reflag. Okay? And to some extent, this is what I find. So here I'm looking at changes in some ship characteristics in the 3 months following the loss of another ship within the same group. And I find more reflagging, slightly more reflagging, and in particular, more reflagging to flags of convenience defined based on my narrow definition of flags of convenience. Okay, I don't find anything for the broader definition, also probably because here the sample size is too low, and there are already few ships in the first place that are not already part of a flag of convenience defined based on the broad definition. Okay. So there is some suggestive evidence, but not too much. Okay.
Yeah, we have 2 minutes, yeah?
Yes, so that's exactly I was about to conclude. Let me just say I have a third part, which is much more exploratory about the end of life of ships and the clean or dirty recycling of ships, so predominantly dirty recycling. But this last part is much more exploratory. And so I'm not going to present it for the sake of time. So let me just conclude. So this paper shows that over the past 4 decades, shipping companies have changed structure quite dramatically in order to evade potential liabilities or potential responsibilities through the use of 3 things: one-ship subsidiaries, flags of convenience, and this thing I did not discuss, which is what I called last voyage flag. In 1 minute, about the implications. So first, what it may imply is that to the extent you believe that regulation in the first place is needed to some extent, then it means that because companies have been able to evade part of that to a large extent, then perhaps transport costs were maybe too low compared to what they would have been otherwise. And so globalization may have been somewhat too far. Okay. Second, it has some implications for debates on extended forms of liability. And in particular, among lawyers, there are debates which are not very discussed in finance, but about extended forms of liability, in particular between parent and subsidiaries. And third, I think this also has some implications for the way we think about corporate social responsibility, and in particular for the measurement of it. And in particular, when we think about measurement of CSR, we need to be very careful about the ability of corporations to evade or to hide some of those liabilities in some small subsidiaries. Okay. And with this, I'm done. Thank you very much.
Thank you, Guillaume. Discussant is Oren Sussman from the Said School of Business. Oren, you can load your slides. You have 20 minutes.
Thank you very much for inviting me to discuss this paper. And I will start with disclosure that most of my comments today are based on common work, joint work that I'm doing with LBS colleagues. Among them, our esteemed chairman today. We have this paper for quite a while, and I have to admit that we were not very successful on publication. Hopefully, the entry of Guillaume into the area is going to create some difference of opinion and perspectives, and maybe we can all benefit privately, of course, from the debate. There's one thing that I absolutely agree with Guillaume, and this is how fascinating the shipping industry is. It's where much of modern capitalism was born. The corporate form itself was born in shipping, insurance practices, banking. It's probably one of the most competitive industries in the world. Although I think that there needs to be a finer distinction about regulation between tax regulation, governance, and the environment. It obviously highlights very topical issues like globalization and the environment. And lastly, it has fantastic data. I think this is just to illustrate a map of the world with the location of each and every vessel, where it is coming from, where it is going to, and what it is carrying. So I think that this enthusiasm for the industry comes across very nicely in Guillaume's book. To summarize, I don't think that I need much. I think Guillaume was very clear, but basically it's the law of the jungle prevails in shipping. Owners can vanish if they exist at all. Subsidiary structure, flags of convenience, race to the bottom, last voyage flags, which in the paper but not mentioned. And I would like to say that we don't contest the evidence as documented by Guillaume, but we do have a bit of a different interpretation of and I've tried to organize these differences into 6 comments. The first one is that if you think about it, shipping is actually an industry that is very easy to regulate. Although vessels spend most of their time on the high seas, namely in no man's land, they make 100% of the cash on land. And not only that, they access land via very narrow gateways, namely ports. So it's very easy to capture them and regulate them. I don't quite see the things as Guillaume sees them, as if the industry has masterminded and outsmarted the regulators. It's in areas where the industry is not regulated, this is because the sovereigns decided not to regulate it. And by the way, it's not a particularly connected industry. We hear scandals about regulatory capture in finance or in extraction every week now, almost. Greensill in England is obviously a big thing. What was the last time you heard about a connected ship owner? Not that many. The second comment is that shipping is a fixed asset industry. And as a fixed asset industry, it tends to be very highly levered. So a lot of industry structure is being driven by finance. And I think that there's in the paper too much emphasis on the evasion. By the way, the financial difficulties or the financial constraints of the industry are exacerbated by the fact that it is also one of the world's most volatile industries. So the Baltic Dry Index is the main price index for leasing, for charter rates in dry bulk. I mean, the bulk is carrying things like coal or iron ore, etc. You can see how the index has collapsed fantastically after the financial crisis and never recovered. So the constraints imposed by finance have to be kept in mind whenever you look at the industry. So let me explain how finance explains some of the issues that Guillaume is talking about. The first of all is flags of convenience and ownership. And here you have to remember that flags like registries of land or automobiles are basically a repository of ownership rights. Their role in regulation is very, very minimal. If you buy a house and you are worried about the neighbors, you are not going to go to the land registry in order to check the neighbors. And if you buy a car, you might have some quality registered with the automobile registry. But no one of us will buy an expensive car on that data. We should bring our own survey. So that's how we have to think about flags, repositories of ownership. And flags of convenience are to a large extent privatized repositories. Interesting, private repositories have attracted a lot of excitement in another area, and this is blockchain. What is blockchain? It's a privatized repository of ownership or information. So there is no necessary connection between convenience and quality or regulation of the assets. I mean, if you think about the Marshall Islands, for example, or Norway that has a flag of convenience in addition to its national flag, and compare it to some of the more notorious countries in the world, the standards in the Marshall Islands or in Norway are much higher than some countries that I will not name for good manners. At the same time, flags play a crucial role in finance, because when you take a mortgage on a ship, you register the mortgage next to the ownership. I mean, that's how it's done in housing, and this is how it's done in automobiles, and this is how it's done in shipping. Now, no bank in its right mind would lend money to a ship owner if the vessel is registered in some dodgy country or dodgy flag, by the way, with which the owner has some sort of political affiliation or connection. So from that point of view, at least on the side of quality of registration, there's actually a race to the top and not a race to the bottom. So you can't make this automatic connection between privatization of registry and the race to the bottom. By the way, creditors usually contract access to vessel in order to survey the quality of maintenance, because if the vessel is not properly maintained, the value of the collateral is deteriorating, and that is a much more effective way of monitoring quality relative to exactly as it is in housing or automobile. The fourth comment is that as a fixed asset industry, shipping tends to have a very high leverage. And with high leverage comes the risk of bankruptcy. And with risk of bankruptcy, the probability of a creditor's run or asset grabbing, or what is called in the bankruptcy literature, the common pool problem. And obviously the problem is exacerbated when the assets are spread all over the world, sometimes in no man's land and sometimes in territorial waters of very dodgy countries. So go back to your Econ 1 textbook and think about what is the textbook solution for a common pool problem. The solution is to privatize the pool. And that is done in two ways. One is parceling the asset pool and allocating rights specifically on each and every bid, and then tightening the seniority interest on each one of the bids, namely very strong creditors' rights. And here, subsidiary plays an important role, right? Here's one example that we discuss at length in our paper, and this is how subsidiary is being used in an instrument that we call the double mortgage. There's a practice in shipping whereby banks take security interest first in the vessel itself as a physical object, and then tighten the security interest further by taking the equity, the shares, in the registered owner, the registered, not in the beneficial owner, as a second collateral on the same object. And the advantage there is that you can repossess the vessel by just moving the register from the owner's account to your own account. And you can repossess vessels in 5 minutes, even if they are on the high seas. And we give examples of that. And we argue that actually this is a very effective way of dealing with a common pool problem. Here's an indication. You would imagine that a creditor run would, or an asset grabbing will be seen in the data as an incident where all the creditors are grabbing and arresting the vessels. Here is an example of one operator, Eastwind. The time scale is bankruptcy time. The blue line is the total capacity of the owner in deadweight tons, and the red line is arrested capacity. And you see that there was some conflicts of interest, arrests, etc., but very, very limited. And we think that this is typical of the industry. By the way, in this case, Eastwind never went bankrupt as a beneficial owner. It was only the subsidiaries that went bankrupt, and then they were consolidated in the New York court. So it's by compartmentalizing the owner, the beneficial owner, it's much easier to protect the secure bits from contagion from the risky bits. So you might think that I'm drawing a too optimistic and too pink picture of the industry. Obviously, there are externalities, and this is a serious problem, but it also has a solution, and this is the solution. It's called COFR, which is an acronym for Certificate of Financial Responsibility. It's a US Coast Guard document that every vessel has to show when it sails into territorial waters of the United States, testifying or confirming that environmental hazards are indemnified by a big insurance company. And this is a very effective way by which the owner, via the insurance premium, by the way, you are not going to allow, regardless of your technical characteristics, you're not going to allow entry even into territorial waters of the United States without COFR. So all the side of checking and pricing the risk, all that is being privatized, and at the same time the protection to US waters is very significant. By the way, I don't think that you will find that level of protection for physical on-land assets. And there are plenty of examples of on-land facilities that went bankrupt and left behind huge cleanup bill that there's no one to pay. And it is an interesting question why the shipping industry is regulated better in that respect than on-land facilities. By the way, oil spills are falling over time. This is to a large extent because of the move from single hull to double hull, but that move was affected by seriously by regulation. So now the difficult part. Is it the case that all the problems are solved? The problems are not solved, and they are not solved in countries like Bangladesh, where the government is too weak in order to regulate something like copper. And Guillaume has shown some photos. Here are some additional. It's really one of the living hells of this world. You can see here how workers, sometimes barefoot, no protection, are going onto vessels which are not even properly anchored and guarded, that they are just stuck into the sand, start breaking it down, parts fall, people get killed, and huge amount of pollutants of asbestos and chemicals are just flowing into the territorial waters of Bangladesh. The share of the polluting of these kind of countries have increased dramatically over the years. This is the share of Bangladesh, India, Pakistan, and China in breakup. Some of you may remember the scandal that erupted a few years ago, where Larry Summers, as chief economist of the World Bank, has signed off a memo that said we have to dump our waste on thinly populated third world countries. Bangladesh, excluding outliers like Singapore, is probably the world's most densely populated country. Larry Summers had to apologize time and again, but the practice was going strongly in that direction. Here is a regression that documents a premium of about 30% or 30 to 40% for breakers who operate in Bangladesh, India, and Pakistan. Why can they pay a premium? Because the cost of breakup is lower, because environmental regulations are so loose. So here's a back of the envelope calculation. The world fleet is about 50,000 vessels. Typically a vessel lives for 30 years. So the steady state breakup flow is probably 1,700 or around that. In recent years, the last price was 4.5 million, or the final price, or the breakup price, was $4.5 million. If you are willing to interpret the 30%, 40% in the previous slide as the shadow price of cleaning the industry, you get a number of about $2.3 billion a year, which will take to save the life and the livelihood of the poor people who work in this industry in Bangladesh. This is peanuts. I don't have good numbers on the value of merchandise shipped per annum, but I guess it's at least 5 trillion. So for a few fraction of a tax imposed on the industry, you can easily solve the problem, but that would require serious government action, because the government of Bangladesh is not capable or not interested, or whatever other reason there is, to solve the problem on its own. So if we, the developed countries, really want to solve the problem, we can. Now, all that, I think, is showing very dramatically into the big question of this paper and this subject. So by definition, market failures are impossible or extremely hard to decentralize. Now, the whole idea of ESG or CSR is that somehow through a combination of governance and accounting and public opinion, you can induce companies to be responsible. If anything, I think the shipping industry shows that this is not working. Because if you try to deal with systemic problem at a corporate level, the easiest solution is outsourcing. Outsourcing to another company that doesn't care about taking on the systemic problem. So the question has to be asked somehow very dramatically. Can we decentralize these CSR problems, or can't we? And if we can't, there's no other solution but hard regulation of the industry where necessary, and leaving it alone in areas of corporate governance or credit where it actually does quite well. Thank you.
Thank you, Oren, for an excellent discussion. I'll just open it, I'll just collect some questions for Guillaume, and then Guillaume, you can then answer it all together and also respond to Oren's comments if you wish. So let me just quickly go to the participants list. Michaela, you're first on the list.
Thank you everybody. So I have two questions for Guillaume very quickly. First one, are you really sure this is a paper on corporate limited liability? Because this industry characteristics looks to me very peculiar. And if you look at the overall trend is actually basically, if you exclude the banking industry, is actually reducing the number of business groups overall. So let's say this difference between ownership and control. So I wonder if you're not talking more about regulation arbitrage first. And second, since you stress this limited liability point, can you give us a number of this cost, of these benefits? Because maybe I missed that. I see a lot of this regression, but what's the marginal cost of benefit to have this kind of regulation advantage? Thanks.
Stefan?
Hi, so I was wondering about generalizability. So basically, I mean, ships are fixed assets mostly in an accounting sense, whereas in other industries, fixed assets are kind of fixed.
We can't hear you.
Kind of shift.
All right, Guillaume, that's, there's also another written question, I think from Orca, which you've already answered, I believe. Orkun, do you have any other question? Not. So Guillaume, I'm going to give it to you. You can unmute yourself and perhaps answer if you wish.
Yeah, thanks a lot. So thanks first to Oren for the fantastic discussion. It's really helpful, and all your deep knowledge of this industry clearly helps. So I may not go into all the details, but I will try to give an overarching perspective on how I think about that. And then I will be very happy to get your slides to go in deeper details when revising the paper. So my view is, clearly, I think that the financing aspects play a very important role at the beginning of the life of ships. And that's clearly explained where they register, which flag do they choose, what exactly is the status of mortgages or collateral, how easy is it to reprocess, and so on, at the beginning of their life. What we see, however, and that's not something that is very prominent at the moment in the paper, but I'm working on at the moment, is that you really have a life cycle of flag quality for ships. So I think on the average, a given ship flies about 5 flags over its lifetime, and if you find measures of flag quality. So, for example, that can be the number of international conventions that has been ratified, or that could be the average rate of detentions for ships registered within that flag. You see that as ships become older and older, they get to worse and worse flags. And so I think that really, indeed, when you have a ship that is young and being financed, you want to be in a flag that has good reputation and top standards, including some flags of convenience which do have such high standards like the Marshall Islands, which you mentioned. for two reasons. Well, first of all, to get the financing, as you said, and second, to also avoid state control, because of course, if you fly a worse flag or a flag that has worse reputation, you are more likely to get control. But of course, as the flag is hedging, I would argue that those financing concerns are less relevant, and the issues of perhaps evading some regulation may become more important, and there may actually be some specialization, at least among the low quality flags. There may be some specialization of the flags, which something I'm currently digging into. So that's, I think, for the financing aspects, and of course I could go into more details, but we will not have much time. So to answer to Michela, so on your first question, so clearly there is an issue of regulatory evasion. On your point on groups and subsidiaries, so I'm not aware of the fact you are mentioning, so that there are fewer business groups worldwide. I don't know whether it's true or not. I believe you, but I think I'm not sure whether it's true for subsidiaries. And actually, I think that the number of subsidiaries within a given group has increased over time, even in other industries. And for example, there was, this fact has been documented already in some papers. There is one older papers in the Journal of Political Economy that shows that when the US regulated chemicals much more, many firms in the chemical industry have broken up in many small subsidiaries. And so that could potentially be going on in other industries, but it's typically very hard to observe and to work with subsidiary data. I mean, all of the work with CompuStat is always, or almost always, with groups. And at least one reason why I'm looking at this industry is that here I can very well observe every single subsidiary, know what they do, so that helps, but I don't exclude that these type of trends are also going on in some other industries where it's simply harder to observe. So now I got the question by Stefan in the chat. So could the results extend in other industries? So that was just my answer, but you were asking specifically about R&D or patent-heavy industry. So that may play a role. I mean, for other industries, you need to keep in mind that there is also some extra concern which would play a big role, which is tax evasion. And very often, flags of convenience and tax havens are essentially the same countries. And we know, for example, that Google has patents located in Bermuda Islands, I think, or you have many other examples like that. And in those cases, I think it's more for tax reasons than for liability reasons. But of course, it's hard to disentangle just because those countries are typically the same.
All right, thanks a lot, Guillaume, and thank you again, Oren. I think we don't have any questions. We're going to start the next paper at 2 o'clock, so you can get some caffeine or whatever you want, and you know where to get it.
I make quickly?
Oh, sure.
Point.
Sorry. Yes, yeah. Please.
So I wanted to make a comment about limited liability. When limited liability was created in England in the 19th century, one of the strong motives was to tighten responsibility rather than dilute it. And the reason was that when you equalize liability on active owner, controlling owners, and non-controlling owners, you actually dilute the responsibility of the controlling ones in favor of the non-controlling one. So there's fascinating 19th century literature on that, including by John Stuart Mill, and it's still very much worth reading.
Actually, I'm now working on a paper on economic history, precisely on the origins of liability in England. So I'm actually digging into these archives quite a lot at the moment.
Julian and I have a paper on that. So.
Okay, yeah.
All right. Okay, so we'll start in 2 minutes, the next paper. Yeah, so the next speaker is Eyub Yegen, and he presents his paper on privatization of prisons. You have 25 minutes.
Perfect. Thanks so much, Vikrant, and thank you very much for having my paper on the program. It's greatly appreciated. So today I will be speaking about my job market paper, which is on institutional ownership and the consequences or the social consequences of privatization, in particular prison privatization. And so over the past 3 decades, there's a increase of, I would say, like a reliance on privatization. So by policymakers, and policymakers have actually been outsourcing certain types of government services to the private sector. So there's a lot of, I would say, reliance on certain sectors. And in particular, one interesting sector is the prison industry. So there's actually a lot of, I would say, privatization that has been done over the past 16 to 20 years. And even before then, there was a lot of, I would say, privatization done in this area. And if you look into the pattern, so the number of inmates in private state prisons that has actually gone up by about close to 50%, and more than 400% if you look into these private immigration detention centers. And the biggest, I would say, the concern that people have had is that, so there are these efficiency gains that we know that potentially can exist. So there's, let's say, private enterprises have higher incentive to, let's say, cut on costs, and that could lead to, let's say, like an increase in efficiency, increase in profitability. But then the biggest concern from a theory point of view is that when, let's say, there are in certain situations, so let's say when contracts are incomplete or when there are concentration type of issues, private enterprises may actually focus on short-term returns, and that may actually lead to, let's say, these negative externalities, which will also have an impact on the overall, let's say, social impact of these outsourced government services. So that has been, I would say, a discussion in both academia and also on the industry, and also within the policy spectrum. But in this paper, what I will be interested in is that there may be actually differences in, let's say, listed versus unlisted firms that manage these type of, let's say, government services. And the reason why I wanted to look into this tension or into this area is that there's, let's say, a difference between the ownership structure, like between the publicly traded versus the non-public traded firms. Media visibility is quite different. Litigation risk and reputation risk is different. Compensation structure may be different. So there are differences in the listed versus unlisted firms that could, let's say, potentially have an impact on these negative externalities. I will be exclusively focused on the ownership structure. And the reason is that there's a lot of media attention on this. And also, I would say, from an ownership perspective, there's a lot of, I would say, potential to understand why they would be, let's say, or why they could be, let's say, these negative externalities. Short-term versus long-term investors may have different incentives. So I will be looking into these type of different effects. But I would say there's also a lot of media attention and call for divestments from the prison industry. So I would say, like, there was even a really nice New York Times article where they literally are, I would say, showing I would say, like a preview of my findings. It's not, they're not citing my paper, but it's pretty much, I would say, consistent with what I find. And I will be, I would say, following some of the arguments that have been made or like some of the concerns that have been made in media as well. And then also in the legislative side, there was a lot of discussion on this area as well. So California, the governor, for example, of California, banned the privatization of prisons at the state level in 2019, at the end of 2019. New York went actually a step further, and they said that they will be not allowing any type of financing activities between, let's say, any company that is being headquartered in the state of New York and these private prison management companies. So there was a lot of pushback, I would say, from certain states in order to, let's say, get away from this privatization or supporting privatization of prisons. And then at the federal level, just a couple of months ago, President Joe Biden, he actually ordered the Department of Justice to cancel or not renew these private contracts with the federal government with these prison management companies. So there's a lot of, I would say, both at the state level and the federal level, a lot of push also from the legislative side that we should maybe be going away from privatization due to potential consequences, such as having an impact on, let's say, the overall quality of these government services. So what will I do in this paper? I will pretty much follow these arguments, but then do it in a more, I would say, an empirically rigorous way. So I will be empirically examining whether there is indeed a social trade-off that arises due to outsourcing these prison services. And I will be following the arguments of the 1997 QJE paper by Harshlife and Nishny, in which they argue that, let's say, if contracts are incomplete due to this incontractability or this incompleteness of the contracts, there's going to be a potential side effect of, I would say, outsourcing certain type of services to, let's say, the private sector. And in particular, they actually have a nice setting where they test the implications of privatizing prisons and what that actually can have an impact on, let's say, the outsourced government service and its effect on, let's say, the inmates overall. And then what I will be doing is that I will be looking to whether there's a difference between the social costs across, let's say, listed versus unlisted firms. look into also whether concentration can play an important part in this. And then the main focus of the paper is going to be to look into whether institutional investors of public companies may actually have an impact or may, let's say, have an effect on, let's say, these social consequences. If you look into, let's say, recent theoretical papers, they would both, I would say there's a paper by Hart and Zingalis, and then also Benabo and Tirol's paper. Both of them would actually argue that it should matter, ownership should matter. And Hart and Zingalis would actually say that there are these non-pecuniary preferences that, let's say, shareholders may have, and that may actually be reflected in the managerial decisions as well. If, let's say, we are shifting more from a profit maximization point of view to a more, let's say, a welfare of the shareholders maximization point of view. So they say that it's actually, it could be better if we do these type of, let's say, shiftings. And that would actually include also these social costs as well. Let's say if there's non-pecuniary outcomes that would matter to shareholders. Benabo and Tirol would argue that these improvements in the corporate social responsibility of these portfolio firms would be driven by, let's say, a fact that there's a shift in the long-term orientation of these corporations. I will be focusing more on this argument that it could be a shift, let's say, due to a shift from a short-term perspective to a long-term perspective. And I will claim that it could be driven by the fact that there's a shift by long-term, a replacement of short-term investors by long-term investors, and it actually could play an important role in, let's say, the overall improvement of these social, let's say, outcomes in prisons. And then I will be looking to why or what type of institutional investors are more attentive to corporate social responsibility, and also study why, let's say, they actually do care about these outcomes. So the main finding is that I do find that prison privatization indeed is associated with a rise in the number of suicide. It goes up to about 40%. And then prisons that are managed by listed firms, they actually perform much better than the unlisted firms. And I claim that these results are potentially driven by the fact that there's a rise in institutional ownership in the listed firms. And in particular, what happened is that there's a dramatic increase in the long-term institutional ownership levels in these public prison management companies. And that could be potentially helping, let's say, firms to shift from a short-term perspective to a long-term perspective. And automatically, they will be incorporating, let's say, these long-term consequences of neglecting to provide adequate resources in prisons. And then I will be also showing that the results are causal in nature. I will use an identification strategy that relies on a tax code change of these public prison management companies, and claim that the long-term effects are actually impacting causally the social outcomes. And then I will also show that litigation reputation risk may be an important mechanism to understand why institutional investors care about these social externalities. There is a material relevance to them, so they will be more inclined to, let's say, care about these social outcomes because of litigation and reputation risk. So in terms of contribution, I would say in the privatization literature, there has been not much of a debate in terms of, let's say, if you have different type of owners, if, let's say, you have short-term versus long-term owners, how are the consequences of privatization? That has not been discussed extensively. So I will be contributing from an empirical point of view that actually it may matter if we look into, let's say, the ownership structure of let's say, the company that is managing these outsourced government services. And then in terms of institutional investors monitoring, there's a lot of, I would say, evidence already in this area that institutional investors are good monitors. They drive CSR outcomes. But I would say my paper is also going to be contributing to this area in a sense that I will show that it actually can have also an impact on human lives. So from a direct point of view in terms of saving like individuals by, let's say, reducing suicide rates and so on and so forth. And then social outcomes mattering to shareholders is also going to be, I would say, an area that I will contribute. I will show that it's going to be consistent with Benabo and Tirol's argument that the results are potentially driven by the fact that it's a doing good by doing well type of story. So there's going to be a shift in the orientation of these firms from a short-term to a long-term perspective, and that could potentially, let's say, also have an impact on the long-term, let's say, decisions that these firms are making. So they will be implementing better, I would say, conditions in prisons. So the main contribution of the paper is going to be to look into really this, I would say, this mismatch that arises due to, let's say, or the mismatch that arises between private incentives of corporations and the interests of society. And that's potentially driven by the fact that these industries are very highly concentrated. And also, I would say, the contracts are incomplete. So these frictions lead to a mismatch between these I would say the interests of these corporations and society. And I will be looking to the ownership role. So what's the institutional investor's role in potentially partially having an impact or partially mitigating these type of mismatches? Awesome. Also, in terms of framework, what I have in mind is that, so just to like lay out the theoretical framework, So there's a contract written between the government and the private prison management company, and based on the arguments of Hartschleifer and Vuillemey, typically they're incomplete. So in essence, so I have access to about 100 contracts as well, and they don't specify much about, let's say, how to handle suicides or so. So there's not much of a debate in terms of what to do with suicides. So in that aspect, what will happen is that these non-contracted dimensions are going to be left over to the owners. So the owners will have the residual right to make a decision on these non-contracted dimensions. So in that aspect, the attentiveness of these owners to social outcomes may actually play an important role in how they will be addressing these non-contracted dimensions. So in that aspect, I will be claiming that from a theory point of view, that there's actually an importance of the ownership structure to understand whether there are indeed these social consequences of privatization. So in terms of the data, there's not a Freedom of Information Act, and I filed it at the state level. And it also includes the Department of Correction of DC. So I have 551 state-specific Freedom of Information Acts, followed up about every 2 to 3 weeks, except of, let's say, holidays, and contacted a lot of lawyers and social advocacy groups to get some support in terms of how I can improve these FOIA requests. So it took me about 1.5 years to get this entire data set, but eventually I actually was able to get a pretty comprehensive data set. It's including all of the states except of the state of Hawaii, and then DC is also included. So it's, and the sample period is going to be ranging between 2000 and 2018. So just to give an example of what I did is, so I filed the Freedom of Information Act, and then I followed about 2 to 3 weeks. And when typically they don't respond to me, what I did is that I initially CC'd the commissioner, and if that failed, typically it worked out. But if that failed, I actually went to the governor's office and contacted them as well, sent a fax message. It bothered a lot of people, so I got some really nasty phone calls. But it actually improved, I would say, the return of the success rate of these FOIA requests. So overall, I actually was able to get a really good data set. So the data set, it looks like pretty much like this in most of in some of the cases. So I have very detailed, I would say, data at the inmate level. It's anonymized, but I can identify who these individuals are through their inmate numbers. And in some cases, I actually, let me go back. So in some cases, so in the state of Texas, for example, I have very extensive data. So in terms of, I know who these individuals are, what their bank routes are, what the matter of, let's say, the exact cause of the death was, not just like these broad classification of suicide, unexpected deaths or so, or just natural deaths, but really the specific reasonings. And then also their criminal history as well. So in that aspect, I do have, in some states, very rich data set, which I'm hoping to actually down the road to exploit more. But since most of the data is going to be at the year times prison level, I will be aggregating everything to the year times prison level. All of the data, it's going to come from the classical institutional ownership data providers, so Thomson Reuters, SEC Analytics, and then SEC Edgar. And I will be following the Ben David and Quartas approach to aggregate the holdings to the parent level. And then also Martin and his Quartas, they have done a good job in terms of identifying some of the missing holdings in this data set as well. So I also follow the approach to correct for some of these missing holdings. ETF ownership is going to come from the classical data providers as well. Litigation data and compensation data is also coming from the classical providers. And to just give a quick overview of what I will be doing, so I will initially test whether there's indeed a positive association between prison privatization and inmate suicides, and then look into whether industry concentration impacts social trade-offs, look into whether the listing type matters, and then go really to the core of the paper, which is going to be looking into whether ownership matters, what type of ownership matters, and then whether this relationship between ownership and the social consequences of privatization are actually causal. And then the very last thing that I will be doing is that I will look into what a potential reason of institutional investors may have in order to, let's say, internalize these negative externalities. So why do they actually care about these social outcomes? So the very first test that I will be doing is that I will test whether there's a relationship between privatization and inmate suicides. I will include time invariant, let's say, fixed effects. So it's at the state level, year level, state times year level. It could be, let's say, some regulatory changes that happen at a given year that can have an impact on the, let's say, the overall, let's say, the budget of the given state. That can impact the suicide. So I will be controlling for those type of outcomes. My most preferred specification is going to be to include prison fixed effects. And I will be observing, let's say, unobserved heterogeneities at the prison level. So let's say if a prison is very bad, it gets privatized. Initially, I don't see much of a change in the outcomes, but then I actually eventually see that, let's say, privatization does seem to have an impact on it. So this within prison analysis actually is going to be really nice in order to, let's say, control for some of these unobserved heterogeneities. Of course, it's not going to be causal. I don't have an instrument here, but it's going to be, I will be showing some associations here. And then I will also include time varying and time invariant prison level factors that may impact the ex ante likelihood. So it could be, let's say, these prisoner characteristics that can impact on, have an impact on the prisoners committing suicides. And then I will follow the following specification. So it's going to be log 1 plus suicide transformation. And to just like plot the results, so I show that there's indeed a positive association between states that allow the prison privatization and higher suicides. And then to take this to the regression form, I do find that there's actually a strong positive association between prison privatization and higher suicides. It goes up to about 40%. And I also did a bit of robustness checks, so propensity score matching, and then also Oster's bound robustness, and I find that the results are robust. And so what I will be doing next is that I will look into whether competition matters. So the reason why competition is actually an important force here is that we know that from existing literature that competition may be an important, let's say, governance mechanism to, let's say, discipline management. But in the prison industry, it's a very, very highly, I would say, concentrated industry. So there's only 25 prison management companies in general, of which 12 are publicly traded. And the sample actually shrinks even further if you look into the number of prison management companies down the road. There's a lot, I would say, industry consolidation. So there are these local monopolies that can have also an impact. And some of the theories that have been written or that have been developed in this privatization literature, they argue that actually that concentration can have an impact as well on the consequences of, let's say, the negative externalities of privatization. So what I find is that there's indeed evidence that suggests that concentration may have an impact on the social consequences of prison privatization as well. And then what I do next is that I look into whether, let's say, the listing type matters. And here the reason is that there may be, let's say, differential characteristics of these listed versus unlisted firms that receive, let's say, these contracts. And the one specific focus I will be having is going to be on ownership structure, but just to look into whether there's a difference between listed versus unlisted firms, I run the following test. And I do find that so overall, both of the types are not good compared to, let's say, the benchmark, which is going to be the government-run prisons. But the listed firms are actually much better compared to the unlisted firms. And it's about like 40% actually of an improvement in the listed firms. But then the question is, why do we see such a, let's say, an improvement in these, or let's say, why do we see like such a good like outcome in listed firms? One potential mechanism could be the institutional ownership type, or let's say that there's more institutional ownership in these public companies, and that's what I will be looking into next. And then I will be looking to whether the long-term versus short-term institutional ownership may actually explain some of the differences as well. And then look into these granular level institutional ownership types and follow the exact same specification as before. And what do I find? I do find that overall, there's evidence that suggests that there's a negative association between institutional ownership and suicides. And then if I break it down even further, I find that it's actually driven by the long-term investors. So long-term investors may shift the orientation of the corporations, and that will have an impact as well on, let's say, the likeness of these corporations to incorporate, let's say, negative externalities as well, because they will be caring about a long-term return. So if they, let's say, neglect to provide adequate resources in the short run, that actually may have an impact on, let's say, the long-term success of, let's say, the portfolio firm. So there is going to be a shift in the orientation of the firm through this long-term ownership increase, which is also what I'm capturing here potentially. And in the next slide, I find that, so I also showed that the ETF ownership results are holding. So my identification strategy is going to be relying on ETF ownership. That's the reason why I wanted to also show the uninstrumented ETF results. And I find here evidence that suggests that there is indeed a negative association as well with ETF ownership and suicides. And then to just like plot the total effects, there's about a 1/3 of a reduction in the suicide rates. If you look into, let's say, the overall impact, if you, let's say, a shift from a 0% to 100% of institutional ownership, there's about a 1/3 reduction, which is relevant, I would say, finding for policymakers or in general for academics as well. And then in terms of all the outcomes, I looked into, let's say, what exactly is happening within the prisons. I actually find that, let's say, the correctional officers per inmate is being improved when you have, let's say, more long-term ownership. Other outcomes as well that I looked into. So I looked into, let's say, also the, let's say, suicide prevention programs, social programs that are being offered in prisons, overcrowding issues. They all seem to be improving overall when you have more long-term ownership. And I also looked into, let's say, different outcomes, different mortality rates, and then different definitions of ownership. and then also different models, and also removing some of these, let's say, prison management companies and Department of Corrections at a given time, and then re-estimating the regression to see that if there's, let's say, a outlier driving the results, or let's say if, let's say, clustering matters, or there's different, let's say, things I need to do. So I have done a bit of a robustness check, I would say, in terms of, and overall, I find that it's robust to these alternative specifications. But of course, so far I have just shown you that there is potentially a negative association between institutional ownership and suicide rates. But then there's this self-selection potential of institutional messes into good prison management companies that may be driving the results. So that's, of course, a natural concern. And what I've done is that I've identified a tax reform that is likely to be useful to overcome this endogenous concern. And what happened is that at the end of 2012, the IRS has actually reclassified these publicly traded prison management companies as real estate investment trusts. And what happened then is that after this reclassification, the prison management companies actually entered into ETFs that track the real estate sector. So there was this increase in the ETF ownership levels in public prison management companies. And then in terms of exclusion restriction, of course, this is something I cannot rule out, but I have done some robustness checks in terms of looking to whether dividend structure matters, or whether, let's say, tax code changes have an impact as well, because these are also outcomes that have changed through this reclassification, but they don't seem to be driving the results. And then just to plot the ETF ownership pattern. So there is indeed this increase, I would say, after 2012, which we don't observe for all of the other stocks that are publicly traded, all of the other firms that are publicly traded. And what I will be doing is that I will instrument the ETF ownership level by treatment, where I will define treatment or define a treated group as the prisons, or the set of prisons that are managed by public companies prior to this reclassification, and then use these fitted value in the second stage. And what do I find? I do find that indeed the results are causal, so there is indeed evidence that suggests that ETF ownership may lead to a reduction in suicides. And then I would say, so far I have shown that there is prison privatization indeed seems to be positively associated with higher suicide rates. Overall, the prison conditions are bad for privately held ones, but then if there's more institutional ownership, institutional investors, in particular long-term institutional investors, seem to be improving the overall conditions in prisons, likely due to the fact that there will be a shift of, let's say, a focus on, let's say, the long-term returns rather than the short-term returns that could, let's say, have also an impact on, let's say, incorporating these negative externalities based on the Benabo and Tirol's arguments. But then the question is, why do they care about these outcomes? Why, let's say, do institutional investors that, let's say, have a long-term orientation, why do they suddenly care about, let's say, the overall, let's say, prison conditions? It's at the end of the day a very small fraction of their portfolio, so you may say that it's not much, let's say, they don't have, let's say, or large ownership stake that may have an impact on, let's say, the decisions that are being made by these corporations. But what I will be claiming is that they actually may be, let's say, these litigation and reputation risks that are relevant to, let's say, the overall portfolio returns of the let's say, this institutional investors. So there are actually these, I would say, like social advocacy groups that literally have developed these websites. So there's prisonfreefunds.org, for example, that allows you to check if you, let's say, have exposure to, let's say, the prison industry through your holdings, let's say, with State Street or different type of, let's say, products, let's say, through a passive index or so. So there's a lot of, I would say, push to divest from these type of, let's say, investors' holdings or these investors' products, because you will be having, let's say, otherwise an exposure to these bad stocks. So overall, it can actually have an impact. Let's say a small fraction of a firm, or let's say an investment of, let's say, BlackRock or State Street portfolio may actually impact overall fund flows. So in that aspect, it may matter. So let's say the reputation, if, let's say, there's a lot of media visibility on the portfolio firm, so if these let's say, prison stocks are doing really bad from a litigation reputational point of view, that may actually have an impact on the manager's decisions as well. So that's what I would say, prior literature has also been advocating. And what I will be doing is that I will follow this, the prior literature to rank the states in a given year based on a survey in terms of how friendly these, let's say, a given state is to, let's say, the sued corporations. And I will be ranking them into, I will be putting them into 5 quintiles and then checking whether, let's say, a prison that's located in the state of California, will that actually be impacting, let's say, the overall attentiveness of owners and, let's say, having an improvement in the overall prison conditions. So what I will be doing is that I will be interacting these quintiles with or these lactic quintiles with the ETF ownership levels and check whether, let's say, if there's more ownership in a given prison in the state of California and there's a high increase.
You have less than 2 minutes, yeah.
Sounds good. Awesome. So I would say that this test would be then suggesting that if, let's say, there's a prison in the state of California, there's a high increase in the litigation risk, then the owners may actually care more about these outcomes, because otherwise it will impact their reputation as well, and it can have an impact overall on their fund flows. So what I do find that there is indeed this positive association, or there's this negative association between an increase in the litigation risk and the ETF ownership, interactive with the ETF ownership results, with the, let's say, the suicide outcome. So the more, let's say, there's higher litigation for a given prison in a given state, the owners are more likely to actually care about these outcomes. But then, of course, I was using just the uninstrumented ETF ownership levels. There's again this endogeneity concern. So what I will be doing is that I will be interacting these quantiles with ETF ownership level, and then using the instrument as before, and then using these instrumented variables or these instrumented outcomes in the second stage. And what do I find? I do find some evidence that at least it's like in the first two quintiles that there's indeed evidence that if there's, let's say, higher litigation risk, that these institutional investors actually care more about the concept or just outcomes on the portfolio firm level. So to just wrap up, what do I find in this paper? I find that there is indeed evidence that suggests that there may be these social consequences that arise when we privatize prisons. Concentration actually has an impact as well on these social trade-offs, and listing type matters. And then within the listing types, I find that ownership actually is an important mechanism to understand why we see differences between listed versus unlisted firms. And in particular, long-term institutional ownership seems to be the driving force between, let's say, the differences we observe in listed versus unlisted firms. So in that aspect, it may matter to, let's say, to an understanding of, let's say, why do we see negative consequences of privatization. We need to look into the ownership structure as well, because that can help us an understanding in terms of why institutional investors care about these corporate social responsibility and such. And in that aspect, it's going to be, I would say that's the main takeaway of the paper. And I think I'm just over time, and I'm looking very much forward to Martin's discussion.
Thanks a lot. You've packed in a lot of words in these 25 minutes.
Oh, yeah.
So our discussant is Martin Schmalz from the Saïd School of Business. Martin, you can put your presentation. Thank you.
Thanks very much. So thank you very much for having me here and having me discuss this very interesting and amazing piece of work by Eyub. Before I start, I want to disclose that I own a portfolio of ETFs that probably covers some or all of the prison companies investigated in this paper. And so I might be biased in favor of these. And I also actually gave a compensated talk at one of the asset management firms that I will mention in a moment. So that in terms of disclosure. So as an overview of the discussion, I want to first frame the research question and its importance and disclose a bit of a prior. I'll overstate it a little bit just for clarity. Then talk about how I would interpret the results if one takes them at face value. And finally, delve into the empirics of whether we should take them at face value or what else I think would need to be done. So my one way of framing the background is there's this perception out there that governments are failing and then universal investors are called to the rescue somehow, no? So we're hoping that universal investors will fix environmental problems and climate change if we just invest in their ESG funds, or stabilize the financial system on behalf of the central banks who don't have the capacities to do that themselves. And, so and the argument is kind of that the universal investors have a stake in the overall economy, they say. And my prior is that's kind of like a bad idea because universal investors don't have a stake in the overall economy, as a matter of fact, and much less in society. And I've blogged about this lately. Universal investors have a stake in the value of the cash flows of the producers, and maximizing producer rents is something very different from maximizing social welfare. No, so they don't have a stake in the environment, not in consumers, not in workers, and certainly not in prisoners. So here comes this paper and challenges my prior and says, sure, they don't have financial incentives to internalize these stakeholder effects, but perhaps reputational and legal risks. And you've just pointed out a few. Right? So now the application is to private prisons, but I just want to highlight that conceptually, this is usually important far beyond the context of prison privatization, whether we should think that these big investors internalize effects on stakeholders. All right, so the second question, does the evidence taken at face value support interpretation? So I'm convinced that these legal reputations, risks have some effect. We just saw that. But I think an alternative, not exclusive alternative benchmark theory is simple agency. So suppose it works like this. More aggressive profit maximization means more aggressive cost cutting. Okay. And cost cutting kind of tends to hurt stakeholders, here the prisoners, right? So if you put more prisoners in fewer cages, then you have lower costs, but that might make them unhappy. All right. So if you have institutional investors that are just lazy principals, monitor prison management less effectively, or give them weaker incentives to maximize profits, you're going to have higher costs, which means less detrimental effects on stakeholders, right? And you can find this good or bad. I'm just saying that is just a more boring and standard interpretation, I would say. So either like that needs to be rejected, that this is the quantitatively important driver, or maybe you will decide to embrace it too. We'll see. Okay, and here's why I think it's important to distinguish that, right? So we wouldn't want to accidentally support a deterioration of efficiency, right? So the Business Roundtable gave itself this stakeholder focus in which they said, we don't want to be accountable to shareholders so much anymore, but they also said we don't want to be accountable to anyone else. And so the concern is that this leads to more managerial slack, right? Now, where my research and prior comes in is that managerial slack causes firms to be run ineffectively. That leads to higher costs of products and production. And that is caused by institutions with weak incentives to govern, which end up being the same long-term investors that are driving the results here. Okay, so not maximizing profits quite so aggressively might be a very good thing in the context of prisons. You know, fewer human rights violations seem like a good idea, but it might be generally bad because like economically inefficient in other firms. So this is basically a comment about external validity, and for that we want to distinguish these theories. So who are these institutional investors? Well, guess what? I have looked at this like 10 years ago, who owns private prisons, because I wanted to write a common ownership paper and was looking for an industry. Turns out BlackRock and Vanguard are the top owners of both. PTIM is Prudential, there's State Street, then there's Arrow Street Capital, that's John Campbell's hedge fund in Boston. There's Fidelity. Oh, look, there's Lakonishok, Schläfer, and Vuillemey. Fun fact. All right. So what we show in the Anton et al. Paper is that institutional ownership of competitors further reduces owners' incentives to push firms to maximize their own profits, right? So in this context, it could just mean they will less aggressively cut costs, right? And that could just weaken these privatization effects, including suicides. So that is just to support the alternative story. So, you know, here's a bit of a joke, right? You know, if corporate CEOs start to buy more jets, few of us would start with interpretation, oh, great, institutional investors now care about suppliers to the firm because they buy more jets. The traditional agency view would be kind of upset. And similarly here, you know, if fewer prisoners die because the CEOs cut costs less aggressively, you know, that there's the agency theory out there that I think we should take into account. All right. All right. Topic 3, should we take the results at face value? So here I want to go through a bit of a short history of prison privatization in the United States and then derive some comments on the empirical design from that. So, you know, let's just think through what would you expect to happen if you were to privatize prisons. Presumably an owner who cares about prison profits will increase revenues and decrease costs. And when you spend 2 minutes thinking about what you could possibly do, you can come up with nasty things of increasing revenue and decreasing costs. So let's see what of them happened. So in the early 1980s, as Eyub described, there was this push to make the government more efficient, obviously, and one of the routes was to privatize prisons. So CCA, one of the big companies that still exists, was founded, and roughly these deals work like this. You give 250 million to the governor of a state immediately that they can use to, you know, do politics against a 20-year management contract in which they pay you 40 million a year or something. Like this are rough numbers to give you the idea. All right. 3 years later, CCO goes public. The pitch being we use less stuff than the public sector. In other words, we're more efficient. And yeah, average starting salaries for the prison guards are lower in the private than in the public prisons by 20% or so. Now, a correlate with that is that inmates serving in private prisons who kind of look similar and have a similar sentence tend to serve 90 days more time. And the reason for that is that there are more conduct violations. In other words, they beat each other up more often because there are no guards that intervene, okay? So I'm not saying, look, private prison owners consciously like violence or incite violence among prisoners because it increases occupancy. I'm just saying, look, they don't have financial incentives to spend resources to prevent more violence, and you know that happens to happen. Okay, so let's talk more. So these private companies, they select prisons, right? So they write letters to the government that says, what we'd really like is large facilities, which, by the way, have less suicides than small facilities. We'd like really young inmates, they tend to be healthier. And here I highlighted an assurance they would like that the agency has sufficient inmate population to maintain 90% minimum occupancy rate over the term of the contract. Like, you know, that's so far regarding maximizing revenue. Here's a risk factor disclosed by CCA. The demand for our facilities and services could be adversely affected by the relaxation of enforcement efforts, leniency in conviction or parole standards, and sentencing practices, or through the decriminalization of certain activities, like doing drugs. And obviously, these laws don't write themselves, so you have to lobby. They have 70 lobbyists at the state level. Legislation happens. So if you've ever heard of mandatory minimum sentencing laws, or truth in sentencing laws, or 3 strikes laws, they were written by ALAC, which was sponsored and even co-chaired by one of the prison companies. There's a guy called William Barr that you may have heard about lately in the last few years. He wrote an essay on the case for more incarceration. It's quite a read. I recommend it highly. Under Clinton, there was a big prison reform bill as well. And it's in this context that Hart Schleifer-Vishny wrote, you know, the proper scope of government and whether you would really want to privatize prisons. Now, how did it work out? Well, here is the incarceration rate from 1930 to 2010 for male, average, and female prisoners. And you can see that right around 1980 and after that, it took off fantastically. So let's say it didn't really have the effect of, say, scaring people off from doing less crime, or at least not to the effect that it would reduce prison populations. This is a total cost to the government of running prisons, and you know that went up as well. So this whole efficiency improvement didn't work out so well, I guess. And the reason for that is not that crime rates went up. The crime rates actually went down since the 1980s, very substantially, in particular for violent crime, in particular for males, okay? So it's just you lock them up for longer. Now, okay, so far you thought this is bad. Now let's pull out the bad stuff, the real bad stuff, okay? So in 2004, the DOJ finds a disturbing degree of physical abuse and underreporting of violence in GEO-owned prisons, GEO being one of the privately, like the publicly traded companies. Now, what they also did is to bribe judges to incarcerate 2,000 children for trespassing of vacant buildings in like poor neighborhoods and stealing DVDs from Walmart, the so-called Kids for Cash program. The thing is that blew up, but the good news is the judges ended up occupying some of the prison beds. So I guess they got some of their money back. So then CCA recorded attorney-client meetings and made them available to the prosecution, which tends to help with, you know, prosecuting people. In 2012, then a judge described a GEO-owned prison where the staff sexually abused minors repeatedly as a cesspool of unconstitutional, inhumane acts and conditions. And just around the same time, you know, public opinion kind of changed on that. And under Obama, there was a trend change, both in the absolute number of prisoners and the relative trends in public versus private prison populations, okay? And that happened heterogeneously across states, and that's going to become important for the empirical comment that I'm going to make. So, of course, they didn't stop. They continued writing bills, like the state representative John Haney admitted that GEO wrote the bill that extended how long you can lock up immigrant children in cages. If you want current news, how do you prevent COVID outbreaks in prisons? You just go 50 times a day, 50 times a day, and spray inmates with pesticides. They tend to get, you know, nosebleeds and, like, you know, they tend to not feel very well after you do that. And my point being, it's kind of imaginable that such treatment would relate to suicide rates, okay? Now, what you have to keep in mind is the message here is, but things would be so much worse if there were fewer institutional investors, right? Because this is like the benchmark of the prisons as they are. Okay, so is this an important question to figure out? I think so. This is one of the few opportunities where we in this profession get to perhaps, you know, have an impact on improving people's lives. All right, so kudos for picking a very, very, very important research question and doing a ton of work on it. All right, so now let's go to the empirics. What happened in this tech shock is, due to this consolidation, there were, I think, just 2 public companies left in 2012, namely GEO and CO, who were in 2012 assessing the feasibility of a reconversion, which you would do to save taxes, you know, socially valuable activity, of course. And they've tried that before and reconverted Anyway, so what they did is they applied for an IRS private letter ruling. The IRS said to these two companies, fine, you can do that. We're going to apply REIT taxation rules to you. So they did convert in 2013, okay? So that affected the two publicly traded firms, but there was no other publicly traded prison with different levels of institutional ownership around. And the reason I say this is just to say that so that we start to get a sense of what the identifying variation is that identifies these coefficients, okay? Now, the other point, and it was clear about this, is what happened after this event is that ETF ownership went up, but not institutional ownership, right? It's just a type of institution that held it has changed, right? So there's a nuance here about whether there's a causal effect of institutional ownership on suicides or whether it is of ETF ownership as opposed to active ownership. And why is that important? Well, because more ETF, like let's call it more passive ownership, means less active ownership, which raises the question of whether passive owners are good for reducing suicides or whether active owners are good at running companies in a cost-saving way, you know? Anyway, so here's a graph from Eyub's paper. So yes, ETF ownership goes up a ton from 2012 to 2013. So I looked into how this came about. And what happened is from 2012 Q4 to the first quarter 2013, you see changes in ownership that are kind of like really big. You don't usually get to see these large ownership changes, not even when you do BlackRock BGI merger or something like that. So yes, things did change, okay? So Vanguard increased its holdings from 6.7% to 12, almost 13% in both of these prison companies. BlackRock had a smaller increase. And where does the money come from, right? Somebody sold these stakes, and it was Fidelity who sold them mainly. And Point72, the hedge fund formerly known as SAC Capital, you know, the Cohen guy who went to jail. So basically the active investors sold shares to the passive investors. Like, look, there's nothing wrong with what Eyub said in that that ETFs are long-term investors. I'm just saying you could also call them passive investors versus active investors. All right, so that's what happened. And the result is, so after Vanguard and BlackRock buy shares from active managers, the private versus public reported suicide rate falls. That's basically what the identification tells you. I was mildly confused about whether the comparison is between the publicly traded versus the government prisons, or whether it's a publicly traded versus a group of government and PE owned, because in PE the ownership change doesn't change either. But I think there were no PE prisons left by 2012 because Geo Group bought them or something. Anyway, so this is one piece of evidence of me being confused about what the identifying variation is. And my, I guess, main empirical comment just to describe that very carefully. So, and why is this important? Because look, there's many sources of potential endogeneity here that Eyub is very well aware, and we had a conversation about this before, right? So I'm not like inventing anything here, right? So the privatization of particular prisons in particular states isn't random. So there's a prison fixed effect in the panel regressions, but you know this thing might change over time. So the public company status isn't random because sometimes a publicly traded company buys a PE company. The allocation of prisoners to prisons isn't random. They could discriminate by health, age, violence, I don't know what. Suicide reporting isn't random. And this is a real concern now, right? Because there's no law that says that the prisons have to keep track about how many people killed themselves or stuff. They don't have to do that. So they also don't have to record that. And of course, that's not per se a problem as long as it's random across public versus private prisons. But you know, that's a testable hypothesis to check or to just describe how reporting differs across the different ownership types. And of course, institutional ownership isn't. The question is just, I think what should be worked out is which of these variations are the results driven by? And like, here's my main message. Like, I think this is interesting no matter the result, okay? So I would not like to see all these problems to be fixed and then we have one message or something like that. I'd much rather get clarity and describe the data very carefully, even if it like changes the message or like makes it not so cleanly identified, whatever. I think this is just so important that we need to get the facts on the table. So, you know, let's describe the time trends in reported suicides by the FOIA requests versus the FOIA versus the suicides that like NGOs report, and what are the trends across the regions, what is the FOIA yield, how does it change before or after 2012, stuff like that. I just would want this to be described, okay? So right, relatedly, many prisons and states claim the data just doesn't exist, and that's okay as long as it's random, but I would want to understand that. Okay, so we had a conversation with Eyub, who is working on a revision of this, saying, you know, let's include a whole bunch of different fixed effects to help us try and understand which of the variations drive the results. Like, how do the results change once you put an ownership type times time fixed effect, or a state time fixed effect and stuff like that. And that would just elucidate what drives these very interesting results. Okay, so to conclude, I think I'm kind of good. So to conclude, this paper's topic is so important and is almost surely going to be used by some sort of interest group one way or the other, that I think it's just very important to make sure the message is right and the intended one. And I say this as someone whose like paper, I guess, has been abused by various interest groups to make policy recommendations that I never stood behind. So I just want to caution that, or explain, I guess, also where I'm coming from with my cautionary remarks here. Right, so does greater institutional ownership reduce bad effects of prison privatization? What we learn here is they get rid of 1/3 of the marginal suicides. Then if it was me, the message would be, look, privatization is bad, even if there's lots of institutional ownership. That's a very different message from saying, look, the institutional owners basically overcome these stakeholder inefficiencies and stuff. And I just want to say, like, there's choices as to how one phrases these things. And doing this, again, is probably less important for the prison privatization debate, which is a political choice anyways, and it's kind of like so obviously a bad idea, in my view at least, that this is not going to change it. But for the broader debate about whether the universal investors are going to solve the world's problems that governments refuse to solve. So, okay, so, and I obviously, like, there's an insane amount of work that Eyub put into this, and just not convinced entirely, to be clear, on conceptual grounds, simply because I think Vanguard and BlackRock are basically just lazy, and that explains a lot of the facts. Not all of them, clearly not the differentiation across states in, like, you know, how shareholder suits are going to work out and stuff, but also on empirical grounds, and not because I say they're wrong, just because I'm saying I don't understand where the identifying variation comes from, and having that clarified would help. Okay,
thank you, Martin.
Thanks very much.
Let's open the floor for questions, and then you can respond, Eyub, after that. Vicente, you have your hand up.
Sorry, yeah, just a small comment, but maybe I'm too much of a theorist at heart. But to me, the concept that politicians are long-term oriented and investors are short-term oriented doesn't hold water from a theoretical perspective, right? Even the short-term investors should, in principle, be long-term oriented. So I think it's just a matter of maybe pitch. But I think it's more about what do they internalize, or what do they not internalize. I don't think that wasn't, by the way, present in the original hard Schleifer and Bishny papers. There's nothing about short-term and long-term there. Exactly. So it's just a matter of pitch, but I think to me that was a bit something that kind of, it didn't ring right. A small comment.
I think that's a great point. I would say some of the results are also driven by the fact that, so there's, if you think about, let's say, what the state legislature representing, at the end of the day represent the electoral, let's say, the preferences or what they view. So there's actually some cases where literally there was a debate in terms of, this is very partisan oriented, in terms of saying that, let's say, we should be using prisons to actually punish people and deteriorate crime in that way. So I think politicians typically speak towards that type of ideological differences, which could also impact, let's say, their, so in that aspect, I'm not sure if it would be, let's say, if these political preferences change over time, then it would be, let's say, shifting them as well. So rather than having, let's say, long-term consequences type of idea, it would be maybe like shift more towards like these political ideologies. So it's a bit more difficult to test this, but that's, I think, what's happening in terms of what's like the difference between, let's say, the long-term story or so. But you're also right in terms of, like, if you look into the differences, the government results are a lot better. So the government-run prisons are much better compared to the privately held ones, and so that's something I'm also still like pushing to like pin down a bit more in terms of what's exactly happening. So how can I clarify this, like I would say the underlying mechanisms more in detail. So in that aspect, it's a good point. It's well taken. I will definitely think more about it.
You can respond to Martin's comments if you want.
Sounds great. No, I think like Martin's comments are well appreciated. They're great and fantastic discussion. I would say that it's the principal agent type of story that you had in mind. It's great. I'm definitely going to think more about this and think about how I can incorporate it into the paper and maybe shift like some of the ideas around that. And then suicide rates not reflecting, let's say, some of the underlying, let's say, conditions in prisons. And that's also well taken. But I would say what initially, so to be like very, I would say upfront, what happened is that, so I initially filed Freedom of Information Act where I asked for a ton of information. So health related outcomes. What I was very interested in was like more the expenditure. So how much money do we actually spend on healthcare, on guards or so? That was a really, I would say the core outcomes that I was interested in. But to be frank, it's the only response that I got was from the state of California. So then I was like, oh, I should maybe shifting my perspective on how to tackle this. And then I spoke with a lot of people in this area, and they said that it's like suicide may be actually a good outcome. It's an issue in these private prisons. You can look into employment type of outcomes. So then I shifted a bit, I would say, the outcome choice. It was a bit more driven by the fact that it's in terms of availability of like what they respond to me. But it's well taken point in terms of there's definitely something else happening as well in the prisons. So I did try to, I would say, check for a robustness check. So in terms of looking at all the outcomes, employment overall, social programs or so, but definitely there's a lot more to be done in terms of looking for maybe potentially different outcomes. COVID is, I think, a nice setting where I can test this as well. So, but how do they dealt with like COVID outcomes? So that's a very good point. And then the tax shock, you're right, there's only 2 publicly traded companies. I think there's only 3, but then the third one is actually also being it disappears at, I think, at the end of 2013. So in that aspect, there's not much, I would say, public firms remaining. But then for the privately held ones, there actually still a few left. I would say like there's about 8 or 9 left that I think remain up until the very end. Some of them like appear later on in the stage. But what I'm actually comparing in that setting is that I'm comparing it to the government-run and these privately held ones. But it's definitely something I would say needs more discussion. So I can add definitely more discussion in this area. And then potential like weaknesses, because this industry is so concentrated that actually really worried me initially that there's not many publicly traded firms to be starting with. That impacts your statistical power. And if I change, let's say, clustering or so, it falls down to the 5% level of significance. So there's definitely, I would say, power issues. So in that aspect, it's definitely something I am fully aware of. And it's great that you pointed out, and there's definitely more room for like clarification in that aspect. And other points as well, they've greatly taken into account like the reporting issues as well. So I can definitely discuss that more in some of the tests that you have proposed. I can certainly run them. Thank you so much, Martin. It was great discussion. And if there are any other questions, I would be happy to answer them.
Excellent. I think we are pretty much done here. Next presenter is Abhinav Gupta from New York University. Abhinav.
So, hi, and thank you so much for this opportunity. And I'll be presenting our paper on Does Private Equity Investment in Healthcare Benefit Patients? Evidence from Nursing Homes. This is joint work with Atul from Wharton, Sabrina from NYU, and Constantine from Chicago Booth. And originally Sabrina was supposed to present, but unfortunately she cannot be here due to a family emergency. So let's get into it. So as a starting point, let me draw your attention to the fact that private equity investment has grown exponentially in healthcare over the past 2 decades. And this is a large and growing segment of the US economy, which will just become more important as time progresses, as more and more of the US population ages. And there has been a large body of work which has documented that private equity funds can improve firm value in a very short duration of time. And as an example, let me point towards our discussant Shai's paper, where he studies private equity investment in the restaurant industry. And he shows that post private equity acquisition, restaurants can increase value because they are actually able to reduce prices and also improve on the quality. And the jury is still out on what all potential levers private equity uses to improve firm value. And so there are stories with product quality, there are stories with management changes, and there's also stories with better access to credit. Our work today will look at private equity in healthcare. And healthcare is a little different from all the existing industries which have been studied, in the sense that there is a lot more opaqueness about quality. There's a lot less competition, and also there are a lot of government subsidies. And so the agency problems associated with private equity might be amplified in healthcare. One, because private equity might have weaker reputational concerns as compared to, say, some of the more long-term players in this market. And second, because of the imperfections within the healthcare sector itself. So again, in the healthcare sector, the customers are not always observing the quality perfectly. The customer is not always the one who's paying, because a lot of the time it's the Medicare or the Medicaid or the insurance who's paying. And there's a lot of market concentration by particular hospitals or particular chains. And this has also resulted in a very large policy debate as to whether private equity funds should be allowed into healthcare. And just a few months back, Sabrina was also asked to present in front of the Congress on this very issue. And so we feel that this is an important question, but this is also an empirical question which has to be answered with empirical facts. So within healthcare, we will concentrate on the nursing homes sector. And why nursing homes? One, they are large. So it's around 160 billion as of 2017. And they are relatively understudied with respect to hospitals, which are the other big sector in healthcare. Second, why nursing homes suit us well is that they are unusual in the sense that they have a high share of for-profit firms. So this will help us because we can identify the effects of private equity over and above the effects of just changing from not-for-profit to for-profit, which is what a lot of healthcare literature has been about. Also, private equity firms have bought both independent chains as well as huge corporates in this segment. So when we can say that our results, we can see if our results are just being driven by corporatization or they are actually being driven by something else related to private equity rather than just any other corporate. And this, because this is a healthcare sector, there's detailed data on inputs, compliance, and patient well-being, which we'll be exploiting. So coming to data, we use two major sources of data for this project. One source of data, the first source of data is from the Center of Medicare and Medicaid, CMS, and we get healthcare data there. And within the healthcare data, we have data on two levels. We have facility level data. So for each nursing home, we have aggregate data on their staffing, their ratings, their costs. And we have patient level data, where we observe each patient within these nursing homes. So we have 100% of all the Medicare patients, which we will be exploiting for the patient level data. And for these particular patients, we also connect them to the MDS. And these MDS you can think of as regular surveys, so regular quarterly surveys where in several aspects of patient health are monitored. And we connect this data to data from private equity deals, which we source from PitchBook. And we then merge the data from PitchBook to these facilities at a nursing home by nursing home level. So finally, we are able to merge around 100+ deals, which account for around 1,700 facilities. And this is about 10% of our data, of the total data. So around 10% of all nursing homes in the data are required by private equity by the end of, say, 2015. So now coming to the empirical part. There are two key challenges when we try to study this effect. The first challenge is that private equity ownership is not randomly assigned to facilities. And the second key challenge is that even when private equities acquire a facility, the patient composition might change. So we'll tackle both of these. So first is the non-random ownership. So we do see that that private equity funds are more likely to acquire facilities which are larger in more urban markets and have a greater share of Medicare patients. And so to get over this problem, we use a simple differences in differences design. And while using the facility level data, what we are going to do is we are going to show you event studies to show you that there are no pre-trends. And in these differences in differences level design, we are able to include facility fixed effects to ensure that we are comparing outcomes within the same facility, and year fixed effects to make sure that our results are not driven by certain, say, business cycles. And we are also able to do a battery of robustness checks on this. And we are able to do the Bacon decomposition to make sure that our results are not being driven by some staggered acquisition by private equities. We are able to vary controls and see that our results are unchanged by different levels of time varying controls. And we are also able to exclude certain deals, exclude the larger deals, exclude the smaller deals to make sure that the results are not driven by certain deal sizes. And private equity literature in the past has also extensively used this approach to study these effects. So coming to the estimating equation specifically for the facility level effects, here J will be the facility and T will be the year. So we'll be regressing our outcome variable on facility fixed effects, time fixed effects, and then a P indicator. So this P indicator will switch on and become 1 whenever a facility is acquired by a private equity fund. And after that, we are able to also control for some time varying patient characteristics and some time varying market characteristics. And we'll present all our results with and without controls to show that our results are robust. And for each of these, we'll be able to show you event studies to verify the parallel trends assumption. So now coming to the second identification challenge. We worry that after a private equity acquires a nursing home, there can be unobserved patient selection. And this can be because of a number of reasons. It can be because private equities advertise more. It can be because they are able to do some sort of different sourcing, or it just might reflect patient preferences. And recent work in the healthcare literature has also documented this effect that nursing homes do select their patients. And this challenge is not resolved by the definitive. It's not even resolved if we had random assignment of private equity ownership. So to solve for this, what we use is a differential distance instrument, which is very common in the healthcare literature. The basic idea behind the instrument is that it is well documented that distance determines the choice of provider for a patient. Even in our data, the median distance to a nursing home for a patient is around 5 miles, and the 90th percentile is around 20 miles. So you do prefer to go to a nursing home which is closest to you. And these patterns remain stable across time. So how do we then define our differential distance instrument? It is the distance between the patient's home zip code to the closest private equity fund owned facility minus the distance from the patient to the closest non-private equity owned facility. So this means that if as a patient, a private equity facility is closer to me, I'll have a negative differential distance. And if a non-private equity facility is closer to me, I'll have a positive differential distance. And the mean differential distance in our data we observe across time is around 15 miles. So now we are able to do this sort of IV estimation in 2 steps. So in the first step, what we do is we use this differential distance to predict the probability that any patient will be treated by a private equity owned nursing home facility. And in the second step, we then use this predicted value of the private equity indicator and carry out the regression similar to what we did for the facility level. And here we are able to again control for facility fixed effects. And also we are able to control for patient market cross-year fixed effects to make sure that the results are not being driven by, again, some composition changes or some changes in the areas where the patients are coming from. So now let me show you first the first stage of the instrument. So on the y-axis, we plot the probability that a patient will be attending a private equity owned nursing home. And on the x-axis, we plot the differential distance to a private equity fund-owned nursing home in miles. And what we see is that as the differential distance increases, so what that means is as a non-private equity owned nursing home is closer to a patient compared to a private equity owned nursing home, the probability of getting treated at a private equity owned nursing home decreases. So the first stage works. And now coming to the main results of the paper, I think we look at 2 major results. So one is mortality and the other is the amount billed per patient stay. So what we first, let's go into mortality. So what we observe is that post private equity acquisition of a nursing home, the probability that the patient will die within the next 90 days from discharge from the nursing home increases by around 1.7%. And this effect is very large, especially for healthcare literature. And it's also large if you consider that the mean value is around 17%. So there's around a 10% increase on mean of the probability that you will die within the next 90 days if you attend a private equity owned nursing home. And then the other concern might be that, okay, even if the quality is some way, the mortality is increasing or the quality is decreasing, that might be because of lower costs to patient. But we also observe that the amount billed per patient stay is increasing by 11 to 17% post private equity acquisition of the nursing home. So there are productivity losses on both ends. One, the mortality is increasing, so you're more likely to have a negative impact on your health of a private equity stay. And second, you are also being charged more for it. And now, just to make this estimate a little more real, we do some back of the envelope calculation. So taking this 1.7% estimate, we apply it to all people who within our 12-year sample period visited a private equity owned nursing home. So that implies around 20,000 additional deaths. And now to compute some sort of number as to the value of life, what we do is for each of these 20,000 people, we are able to estimate the number of life years lost based on actuarial tables. So we get around 160,000 life years. And valuing each life year at 100,000, as has been done in the literature, gives us an estimated cost of around $21 billion. This is significant if you consider that the entire size of the nursing home industry is around $160 to $170 billion as of 2017. Also, we wanted to see where these mortality results are coming from. So what we do is we divide our patients on basis of age and risk, and we see that the mortality results are coming from majorly from patients who are lower risk compared and higher aged. So what this sort of starts pointing to us is that there might be some neglect channel going on, because the mortality is increasing not for the more complex patients, but for the less complex patients. And we will also do some further facility level tests to try and see if this sort of intuition holds up in the subsequent part of the slide. And before going to the mechanisms, so far we've been able to abstract away from the possibility that there is any selection on treatment effects. And we've always been estimating the local average treatment effect. So to get the average treatment effect and get a more general estimate, what we do is a marginal treatment effect analysis. And for this, we make assumptions which are standard in this literature. And we estimate this using a parametric polynomial approach. So let me show you the results. So on the left-hand side, you see the marginal treatment effects with respect to the unobserved resistance to treatment. And here on the left-hand graph, I think two things are of great interest. So first, when you see the red dotted line, this is the average treatment effect. And this is around 1.3%. So you can see that this is lower than our estimate of the local average treatment effect of around 1.7%, but it's still significant. It still means that anyone who goes to a private equity owned nursing home has around a 1.3% chance of having a negative mortality result. The second interesting thing here is that the marginal treatment effect slope is negative. So the value of the marginal treatment effect decreases as the unobserved resistance to treatment increases. And this implies sort of a reverse selection on gains. So patients who have a lower unobserved resistance to going to a private equity facility also experience the worst effects. And this is also consistent with some other analysis we do on heterogeneity, where we see that patients from higher income zip codes are more likely to go to a private equity nursing home and are more likely to be compliers, but they are also exactly the patients who are suffering from worse mortality effects due to private equity ownership. And now coming to some discussion about potential channels. So we try to dissociate, I will go through this in 3 steps. First, I will look at facility level ratings. Second, I will look at facility level staffing. And third, I will look at operational changes. And all these results are at the facility level, so we'll be able to do the standard diff and diffs and show you event studies for these set of results. So first, coming to facility level ratings. So CMS assigns a 5-star rating to each facility. These ratings are based on a number of factors. They include audits by CMS, where they actually go into the facility every year and see if there are any deficiencies. And they also include the health of the patients, and also they include reviews from the patients themselves. We are going to show you 2 ratings. One is the compliance rating and the other is the overall rating. The compliance rating is basically a measure of how many deficiencies are there in the private equity owned nursing home. Lower compliance rating you can think of as the nursing home as CMS finding more errors or more deficiencies in that nursing home. And we see that both the compliance rating and the overall rating decrease by around 3% post acquisition by a private equity fund. And now let me show you some effects on staffing. So we see that the staff hours per patient days also decline post private equity acquisition. And this decline in staff hours per patient day is driven more by the frontline staff. So it is driven by your nurse assistants and your LPNs. And so now tying it all back together, what we've seen is that post private equity acquisition, mortality increases. This increase in mortality is coming from the less complex patients. There is an increase in deficiencies and hence a decrease in the deficiency rating. And finally, there is a decrease in the staff per patient stay. And so all this are highly suggestive of the fact that private equities are essentially reducing the amount of staffing, which is increasing the amount of, say, neglect and leading to higher mortality outcomes for the less complex patients. And now coming to some of the more operational and financial aspects. So what in unreported analysis, what we see is that after private equity acquisitions, we don't really see an increase in net income of the nursing home. So that begs the question that how are private equities generating money for themselves, or how are they generating value for themselves and their investors? And we present 2 outcomes here. First is the management fees. So these management fees go directly to the private equity fund. And we see that post private equity acquisition, the management fees charged to these nursing homes increase. The second is building lease. So we also see that post private equity acquisition, the fees charged for building lease from these nursing homes increase. And this is basically happening because a lot of the value of the nursing home is tied in its real estate assets. So private equities come, they sell the real estate asset to the builder, and they are then able to, and they put this lease cost on the balance sheet. And so net, there is no increase in the net income, but they are able to extract out the real estate value from the nursing home. And consistent with that, we also see a reduction in cash on hand for the nursing homes after acquisition by private equity. So coming to the conclusion. So private equity presence has expanded rapidly in healthcare. And in this paper, we try to estimate the causal impact of private equity ownership on nursing homes. We find that private equity ownership reduces productivity on average. And this is both through the short-term mortality as well as by an increase in spending. And this is likely because of a combination of both the high-powered incentives by private equities and also imperfections within the healthcare sector itself. And effects might be very different in other more market-driven segments of healthcare, such as, say, dermatology or cardiology. But within nursing homes, where these imperfections are stronger, these effects are strong. And I think a future research agenda would also be to explore how private equity fund ownership impacts sectors which have similar problems like the healthcare sector, which is where there is opacity about quality, or where there are large government subsidies, or where there is large concentration. So I think I'm ahead of time, but I would like to conclude.
Thanks. Thanks, Abhinav. Discussant is Shai Bernstein. Shai, you have 20 minutes.
Okay. Thank you very much, Vikrant, and thank you for the organizers for inviting me to discuss this paper. And Abhinav, thanks for a great presentation. So I'll start from the end. I think this is a fantastic paper and an important one. But just in order to just fit this paper in the broader literature, there's been really a long debate around the private equity role in the economy that has been going on for several decades now. And I think it's important to frame that debate to kind of see where this paper fits in. Those supporters of private equity goes back all the way to Jensen 89, arguing that, private equity firms and buyouts provide superior governance structure through the combination of leverage, concentrated ownership, strong managerial incentives. All of these tools are enabling the mitigation of managerial agency problems, and therefore that can improve efficiency, operations, and so on. But then those that argue against private equity suggest that exactly the same mechanisms generate these high-powered incentives that may lead to these misbehaviors that are driven by short-term gains, that basically argue that private equity firms engage in this kind of financial engineering, taking advantage of favorable tax benefits, issue gigantic dividends to themselves, and these kind of financial behaviors may adversely affect employees and customers. And in this paper, the focus is on the nursing home customers. Now, interestingly, the results in the literature are quite mixed. When you look across different industries, you see very different results. So on the one hand, there's quite a bit of support to this positive view of private equity, suggesting that, we see that private equity firms tend to improve productivity in manufacturing sector, enhance firm operations and safety in restaurant industry, increase growth and product diversity for consumers, and even some results that suggest that they improve innovation as well. But then on the other hand, there's some other papers that point out to potential costs associated with private equity. So for example, in higher education, there's some evidence that they tend to increase tuition and student debt and lead to inventory shortfalls in supermarkets. So there's a great variation, and in some sense, the question is, should we even expect to find homogeneous effect and a final conclusion to private equity debate, or should we anticipate this kind of heterogeneity across industries? So one suggestion that maybe private equity applies the same trick across all industries, and in some industries it works well, in some it doesn't. So some suggestion along these lines comes from Axelsson and Al, and in this paper, Axelsson and Al basically looks at the capital structure choices of publicly traded companies and privately held PE-backed companies. And in column 3, what I'm highlighting is basically illustrating that publicly traded companies' capital structure is highly sensitive to the industry characteristics. You can see that the market-to-book characteristics, the R&D, the return on capital, all of these characteristics are influencing the capital structure choices of publicly traded companies. And in sharp contrast, when you move to PE-backed companies, you see that none of these industry variations are driving capital structure choices. But what drives capital structure choices for PE-backed companies is essentially cheap credit. So the interest rate or the high yield bond spread is basically what is explaining the capital structure variation. And if this is the case, and if basically that's the main driver of capital structure, then we should expect that in some industries, this kind of capital structure may lead to beneficial outcomes, and in other situations, the kind of incentives that this capital structure provides might lead to more adverse effects. So this idea that this one size fits all might not necessarily work across different industries. And this is basically the point of this paper, focusing on nursing homes. Now, unfortunately, nursing homes attracted a lot of attention during COVID. A significant portion of deaths during COVID over the last year was tied to nursing homes. So clearly, this particular population is incredibly fragile and sensitive. So understanding how this interaction of private equity and this kind of capital structure and high-powered incentives, how this interacts with this particular population is, in my mind, first-order question and really important one that has important policy implications. So for this reason, I'm delighted to see this paper. I think also the benefit of another important benefit of this paper is the usage of facility and patient level data that allows us to see or to open the black box and see what happens across a wide variety of different aspects associated with nursing homes. And as Abhinav established, the paper established 3 key results that are quite damning for the private equity industry. And the first one is that we find that there's increasing short-term mortality of 1.7 percentage points, that in relative terms, this is 10% increase, which is a very meaningful increase in mortality. The second result is that they find, using various detailed survey, they find that there's increasing antipsychotic medication, increase in pain intensity, there are declines in mobility, so deterioration across different set of results here. And the main mechanism through which the results take place is through changes in nursing staff. So there's decline in the hours per patient and the overall staffing declines. So overall, this is, I think, it's important paper that combines both a massive data effort and important question and area of investigation. So I'm going to focus on 3 areas in my comments and suggestions. I'm going to talk a little bit about the empirical strategy, and mostly we'll focus on what drives the results and the mechanisms here. So the empirical strategy, so as Abhinav mentioned, the paper tries to address 2 issues. One, that private equity firms may target unobservably different facilities. And here, authors are going to include facility fixed effects. And then the second issue is that the composition of patients following private equity buyout may change. And to deal with that issue, they're going to instrument for patient composition using the demographics of the nearby facilities, essentially using the distance from private equity and non-private equity owner nursing facilities. And distance had been shown in the literature to be a very strong predictor for nursing facility choices. Now, one comment that I would like to point here is that these two issues of the patient composition and the concerns about unobservable variation that drives the acquisitions the same in the first place are interlinked. So there might be some time varying dynamic that is leading to the acquisition of these facilities. And in that regard, the facility fixed effects are not going to remove these time varying characteristics. So that's not going to be sufficient. And the problem is that private equity firms are known to approach companies that are in distress, and time trends are, the lack of time trends is useful, but then the question, of course, is whether these kind of anticipations of future changes are going to drive the results and may explain the mortality rate. So that's kind of like an issue that I'll come back to when I get to the mechanisms. But then for the instrument, the use of distance and the reliance of demographics that surrounds the facilities, in some sense, that is also incorporated in the private equity acquisition choice. So in some sense, the question is whether this distance instrument is really orthogonal to the private equity choices of acquiring nursing homes, or whether this kind of like satisfies this exclusion restriction is something that I'm not fully convinced of. Also, consistent with this idea that private equity firms may target struggling nursing homes, there's some suggesting evidence that the nursing caregiving is already deteriorating before private equity firms are coming in. The cash on hand seem to decline before private equity firms are coming in. So there's some there's some concerns about this endogeneity that may be in line with some of the observed results. The other thing that I would like to highlight is what exactly are the deals that are driving the results here. And as Abhinav mentioned, Sabrina testified about this paper in front of the Congress. So this paper has important policy implications. Now, and because of that, it's really important to understand what drives the estimates. Now, overall, the sample includes 1,600 nursing homes. But when you look at the top 10 private equity deals, it turns out that 1,300 of these facilities are essentially driven by these top 10 deals. So essentially 80% of the sample is concentrated in 10 deals. And 7 of these deals took place just before the financial crisis, in the 2008 financial crisis. So you can see that there's significant concentration before the crisis. And as you saw in the previous slide, these deals were particularly large, driving most of the variation in the sample. And that kind of brings this question of, the external validity. Can we extrapolate from these 10 deals to the rest of the sample? And I think, this is a typical issue in any paper, but here, if we want to draw conclusions about the implications of private equity in nursing homes, we really want to understand this external, to the extent that we can extrapolate. And then the pre-2008 period is a period with high leverage, potentially less scrutiny. It's a very particular period, and we want to understand that. In some sense, there's a table in the paper that shows that if you focus on the top 5 deals, the effects are actually going to be even larger, suggesting that these deals, these top 10 deals, are particularly important in driving the estimates in the paper and the mortality results. So I think my suggestion here is just to try to provide a bit more transparency on the importance of these deals, the extent to which the results are driven by these effects, because at the end of the day, the data is highly concentrated within very few deals. The couple of points about the mechanisms here. So the question is what drives the increase in mortality? And the key focus here, so there's results with respect to the leasing costs and management fees and so on. But the one operational change that really ties to the deterioration in patients' health and mortality is nursing staff. And there is evidence that points to the importance of nurse availability, which is arguably the most important determinant of quality of care in nursing homes. So the results in the paper focus on staffing hours per patient day, which is important because even if private equity is increasing the number of patients, scaling that the staffing choices per patient is important scaling thing to do. So we get a sense, conditional on the changes in the applications or admissions, how the staffing essentially fluctuates. And then one more point that I want to highlight is that the paper also ties the finding on the staffing to the use of antipsychotic drugs and so on. So the nursing seems to be an important part in the interpretation of the result. But the interesting part here, and the thing that is hard for me to wrap my mind around, is that the overall change in staffing is actually really, really small. So overall decline in staffing is by 0.05 hours per patient day, and the decrease in the frontline caregivers translate into 0.09 hours, which is 6 minutes per day. So it's something that is quite small. And then at the same time, there's an increase in the use of registered nurses. So I'm trying to understand how that can translate to this 10% increase in mortality. And I think it's, again, try to kind of understand how these magnitudes interact with the massive change in mortality is going to be important. And my interpretation here is that maybe there's some unobservables that are tied to the particular timing in which private equity firms are coming in that can explain this particular increase in mortality. But yet again, maybe we don't see the full picture, and there are other things here that are important to uncover. Another point that I would like to further understand is the use of the mortality dependent variable. So the way that the authors are structuring the dependent variable is basically focusing on what happens to mortality during the stay of the nursing home, which to me, that conflict should be the dependent variable, but then they add this buffer of 90 days after the release from the nursing home. Now, it's not clear to me why this addition of 90 days, but it turns out that this addition of 90 days after the release from the nursing home is really crucial. If you focus on the buffer of 30 days after the nursing home, suddenly there's no mortality results. So I'm basically trying to understand what happens in this 2 months period where patients are no longer in the nursing home, and suddenly we see this spike in mortality. This is something that again, quite hard for me to understand. And are there differences in the population risk here that is important in generating this? Are there some important differences in the length of stay for PE-backed facilities versus the rest? Maybe patients tend to stay longer in areas in PE-backed facilities. So I couldn't find data on the length of stay and variations in the length of stay across PE-backed and non-PE-backed nursing home facilities. But again, this kind of 2 months period where all the effects in mortality takes place is something that I'd like to better understand. And then finally, I think Abhinav mentioned that a little bit, is this idea of, are these results are unique to private equity, or just any kind of ownership change that shakes organizations, kind of like also drive some of these results. But this is something that I think is quite easy to address by comparing to other ownership changes outside of private equity that would be really useful. So I think I'm going to conclude here. So first of all, I think that, you know, this paper is important, focusing on really fragile and sensitive population, and we really want to understand how private equity affect this kind of population. I would like the authors to provide more information on the mechanisms, trying to reconcile the mechanisms with the magnitude of the effects. I'd like to understand better the structuring of the dependent variables and other mechanisms, just to kind of like try to understand how everything ties together, because at this point I'm not fully convinced that you know what drives the effects. And then finally, I'll just end with this kind of like meta point, which is, you know, it would be interesting to try to understand how do we reconcile the different effects that we've seen across different industries. I think that should be kind of like a pretty fruitful ground for future research, trying to understand why private equity seem to work in some industries and maybe work less in other industries. But thank you again, I highly recommend everyone to read the paper.
Thank you, Shai. I'll just open the floor for any questions. If you can raise your hand if you have any questions. Abhinav, do you want to, in the meantime, respond to Shai? And I think your co-authors might be here as well. Please feel free. Constantine, if you want to jump in.
Yeah. So first, thanks, Shai. This was a very great discussion, and thank you for taking the time and having such a good discussion of the paper. So I think I'll be able to address some of the concerns also, because this is ongoing work and we've been able to make some progress on some of the concerns which you raised. So I think one of the concerns you had was on just the fact that these deals are highly concentrated. So like it's just being driven by top 5 or top 10 deals. And we do find that even if we exclude the top 5 deals, our results still hold. But overall, your comment is well taken that the effects are a little larger for the top 5 deals, and we might emphasize that more in the paper. One other comment was that the effects on nursing are small, so it's like just 6 minutes, but that's 6 minutes per patient per day. So, and what might be happening, and this is me hypothesizing, is that those effects are not spread evenly across patients. So basically for the less complex patients, the nurses are not paying them enough attention, and those 6 minutes add up. And for the more complex patients, the difference is lower. And so even though the difference per patient per day might seem low, like 6 minutes, but because there might be some sort of heterogeneity, which across the amount of time these nurses are giving these patients, that effect might be coming. And especially because of the fact that our results are in the less complex patients, and the number of nurse hours are declining for the frontline staff and not for the registered nurses. And the registered nurses would be the ones who would be associated more with the higher complexity patients. So that is somewhat pointing to what is happening, but again, point well taken that we can explain it better and explore it better. Then on the length of stay issue, so the mortality results are driven by patients who are staying for less than, say, 30 days. And they are also driven by patients who are discharged to hospitals. So essentially, I think what might be happening is that these patients come in for short stays to these private equity-owned nursing homes. And after, during the period of these short stays, so less than 30 days, they deteriorate and are again admitted to the hospital. And then they die within the hospital. And that's why the effects are coming even after the end of the stay, because they are being sent to hospitals as their condition deteriorates. But yes, this is a very valid point, and we also tried to address this, and we are working better to address it better and make it better in the paper. But And finally, on other types of ownership, we do try to, again, control for look if the effects are just coming from the smaller facilities which were acquired. And we do try to dissociate between the effects between just regular corporatization versus acquisition versus versus the effect of private equity. And we do find that there's still an effect. But again, I think your point is well taken, that we can emphasize it more in the paper. So and I would again like to thank you for the discussion. And I think that some of the other points you raised also about the empirical strategy are very valid, and we need to write it better and to make it more transparent and clear as to exactly what the exclusion restriction is and what are the various assumptions which are there in these empirical results. So,
Constantine, would you like to add something?
Yes.
No, I'll let Abhinav take reply.
Okay, and I think there was another question on chat. Less likely to let people leave for hospitals. So we did also, from Christoph, and yes, sorry.
Yeah, so maybe let me just, so I think these exit decisions, I was wondering where people go after they leave the nursing home, right? And I understand that they go to the hospital, and then I was wondering who's deciding when people leave the nursing home, right? And so can you do something with the length of stay, average length of stay, or the condition of people when they leave the nursing home? It's clear that maybe private equity owned nursing homes have more of an incentive, or more likely want to sort of maximize profits, keep people in the nursing home until they're really too ill to stay in the nursing home. Then they go to the hospital where they're then more likely to die. I mean, it's a story one could build, I guess.
Yeah, no, for sure. I think we are also actively testing for this story. And what we sort of found was that there is a very small reduction in the probability that people are being discharged to the hospitals, but it is like the magnitude is very small, like around 0.2%. So what you're saying is there in the data, but it's not that it doesn't seem to be economically significant, but we did try and check for that.
And do you have any, I mean, just following up on this, do you have any other data on sort of exit, sort of care around the exit or post-exit? Like in terms of like hooking up people with doctors, or, I mean, anything, do you have any data on or information on whether the exit process happens differently for PE-owned nursing homes versus other ones?
So basically on CMS, we do this two ways. One is that for each hospital stay, we do observe a patient who's on Medicare. So we can follow a patient when after he's discharged from PE and he's admitted to a hospital, we can follow the patient along. Also, when they're discharged from PE, they do disclose where the patient is going. Is the patient going to home? Is he going to a hospice? Is he going to another facility? So using that data, we don't see much difference in the composition of patients on discharge. There's some reduction in the percentage of people going to say hospitals and facilities, but it's small. But we can, I guess it is possible to further follow them in the hospitals and see if something different is happening there. But I think that's also a very great suggestion. Thank you so much for that.
There's another question out here.
Yes.
Bassam, can you just ask that question? Can you unmute yourself?
Yeah, hi, thank you very much for your interesting paper and presentation, and also the thorough review. You know, I've had occasion to sort of look at some of these different types of investments in the marketplace, and you know, it could be the case that the data that you're picking up is sort of a subsample of a particular tier of the type of patient that you're sort of looking at. And for example, I know that there's some interesting things going on in the UK market in the private space in nursing homes that, from a private equity firm perspective, is much more attractive, in terms of the returns, the operations, also the population in which people are targeting. So there has been sort of, I think, a shift from some of the private equity players to go into other markets. And so I just sort of put that out there as another thing to consider as you're really trying to pinpoint something that's very difficult to do.
No, the comment is well taken. I think in targeting, we do see that private equity funds tend to prefer acquiring nursing homes which have a higher Medicare percentage of population. And so the mortality results are also for Medicare patients. And that's basically because those are the patients we can observe in the CMS data. So, and we are not able to observe, say, health outcomes for private patients, but also private equities don't seem to be going after nursing homes which have a high percentage of private patients. They seem to be going after nursing homes which have a high proportion of these Medicare patients. But I think there might be some segmentation, and there might be some private equity funds who are going more after, say, more private patients, and the demands of the market might be driving them to do something different.
Related to that, so are you focusing mostly on short-term nursing homes versus, I wasn't sure whether the results are also capturing long-term stays.
So the facility level results are there for both short-term and long-term stays, but for the patient level results, because we are looking at Medicare, and Medicare only pays for short-term stays. So these are only for short-term stays. So you should think of this typical patient as coming in and staying for, say, 30 days or 20 days. And these are typically after you've, say, had heart surgery or you had an injury and you go to the hospital, and then you go to the nursing home for rest and recuperation. So this is how you should think of the patient level stays. You should make that clear. But so, yeah, that's a very good point.
All right, if there are not any questions, we should stop here. Thank you so much, Abhinav. Thank you, Shai. And what we're going to do is we're going to transition into this joint asset pricing and corporate finance session, which will start at 4. So you don't have to do anything. You'll automatically be transferred to that session in a few minutes. Yeah, it'll start at 4 o'clock. Thank you again.
Thank you, everyone. Thank you, Shai. Thank you, Vikrant, for this opportunity.